Die Sprachübertragung beginnt jetzt. Alle Teilnehmer befinden sich im Zuhörermodus.
Good morning, ladies and gentlemen, and welcome to today's BAI Webinar. Climate Transition and Renewable Energies is our topic of today. I hope you all had a good start to the day. Refilled your coffee cup next to you, so being able to spend the next hour with me and my guests and being able to listen to their presentation, of course. I'm very happy to welcome today Ulla Agesen, Managing Director and Head of Infrastructure at Nordic Investment Opportunities, and of course also a warm welcome to Stig, who's Senior Advisor at Copenhagen Infrastructure Partners. Against the background of this mega election year 2024, and of course also given the fact that yesterday the German government just reached a compromise over the construction of new power plants, I think we have a pretty good timing with today's webinar speaking about not just climate transition, but also renewable energies. But before we start, and I will hand over to Ulla Agesen in a few minutes, just a few remarks for those of you who are listening the first time to a BAI webinar. After the two presentations, we will have a short, but of course a decent Q&A session, and please feel free to type in, write your questions during the two presentations, and we will be able to answer hopefully all of your questions at the end of the webinar. So for those of you who are not familiar with the GoToWebinar tool, the question tool should be on the right-hand side of your screen. Just use these question and chat tools to type in your questions, please. And yes, thank you, Roland. Just apologies for a few more remarks before we start today. We have already an upcoming webinar in our pipeline, so feel free to use your phones now and scan this QR code here, and you will directly be able to, yes, okay, probably a bit too fast. Roland, maybe you can go back one slide. Thanks. You can be able to register for our upcoming webinar in 2 weeks. It's a German-speaking webinar about ESG and IFM in practical. Thanks, Roland. Maybe next slide. And of course, I'm very much looking forward to our upcoming BAI events in Frankfurt. Of course, also feel free to scan this QR code and you will see our event calendar. Many more events to come in 2024. We will start with the Private Debt Symposium on the 5th of March. So today in 4 weeks, hopefully we can meet in Frankfurt and speak to each other in person. And last but not least, just a few marketing remarks for the latest BAI publications. Hopefully you are familiar with our website and all of those publications, but the latest one you can see here, it's the Alternative Investment Outlook 2024 with some pretty interesting remarks about more than 30 outlooks of BAI member companies. Again, feel free to use this QR code. And now I can hand over to Ulla, and I'm very happy to follow your presentation, Ulla.
Thank you very much, and thank you to BAI for offering the opportunity to talk about climate transition, definitely one of my favorite subjects. Nevertheless, so my name is Ulla Agesen. I'm head of infrastructure here at NEO and have been working on infrastructure for more than 10 years and more than 25 years in the industry overall. Transition, as mentioned, is a favorite theme of mine, and I've been writing some articles about it, and I will also be on a panel at the Global Infra Forum in Berlin in March, as well as a super return on transition in Berlin also in June. So I'm hoping to see some of you there. Let's see if I can get this slides to work. I've heard there's a little bit of a delay. Otherwise, Roland, maybe you
Yes,
can
I will do it. I will do it for you.
Thank you, Roland. So very, very briefly on NIO. NIO is not a Chinese car. It's also not the leading role in the Matrix movies. So it stands for Nordic Investment Opportunities, even though we invest globally. So I guess there's definitely room for for confusion here. But what we do is that we offer access to alternative investments to mainly family offices, insurance companies, and the likes, to get access to either fund-of-fund solutions, and we also offer access to CIP's flagship Fund 5 for those who can't meet the minimum ticket size. One key note on NIO is that we very much believe in being kind of eating our own cooking. So we are all heavily self-invested. So we account typically for 10 to 20% of the AUM in the funds that we offer. That's why we use the terminology built for investors by investors. So I'll leave that to the side now, because this is not about NIO, but about transition. And transition in general is something that we've worked on for quite some time, about a year and a half, I guess, in total, where we've worked dedicatedly about it. And we've made 2 investments in dedicated transition fund in our infrastructure fund of fund. We believe the theme can be quite an important theme in an infrastructure portfolio, because it spans different sectors. So you get diversification, even though it is one theme as such. If you look at this particular slide, so there are both areas that kind of push for getting more transition, and there are also some that pull to get more transition. And I think both those factors are important to note. If we take the climate change and the net zero target, the most recent COP28 in November, December, ended with a statement to transition away from fossil fuels to kind of meet the net zero in 2050. And even though that some would have liked a stronger stance, I guess it did represent the first time that you really acknowledged that fossil fuels was a significant cause of this problem. In addition, there were commitments to increase the renewables mix, which is part of this obviously, but also have kind of certain milestones already for 2030 to have significant reductions. Then we've seen a swarm of government policies. I'll come back to those a bit later, but the most significant one obviously was the Inflation Reduction Act in the US, that really has kind of accelerated investments in transition investments. If you look at the two middle ones, that is obviously to quite some extent driven by Russia's invasion of Ukraine, which put more attention on the need for energy security, and also we've seen obviously quite clear energy price volatility in these past years, and that's unfortunately a theme that continues to be present. And then the last 2 points I'm making on this slide is kind of the consumer pull and the corporate pull. So we see an increase among corporations, in particular the big tech companies, Amazon, Google, Microsoft, etc., that are looking to significantly decarbonize and also are heavy users of energy, in particular in the data centers. And then the end consumer is also having some clear demand for a low carbon solution across the board. If you flip to the next slide, we've tried to define what we call climate transition. Quite often it's called energy transition, which is also a good terminology for it. But if you use climate transition, you get kind of the full picture of what we're seeing as investment opportunities out there. And it really is an investment megatrend, both because of these, you can say, these macro effects that I just talked about on the past slide, but also because the need for these opportunities and the need for these solutions are simply very, very significant. We've tried to illustrate it in this box you see here on the left-hand side. So renewables is obviously a big part of energy transition or climate transition, and even though it is this big part, I'll kind of leave that to Stig from CIP to talk more about that later. But it is obviously a big part of transition. If you kind of broaden it a bit further out, then you can see the likes of sustainable fuel, EV charging, so the transport sector is covered as well, so not just energy. It's also about carbon capture, for instance. I'll talk a bit about a case on that a little later. Battery storage. So there are a number of different elements. And if you broaden it out even further, the likes of circularity is a big theme, and I'll give an example of that. But it could also be vertical farming, so solutions to these climate-related issues that we have today. Looking at the chart to the right, you can see the growth in investments in energy transition. So that's mainly the two boxes, you can say, the blue and the gray box. And what you've seen more recently is both there is an increase in investments, and even in 23, which was kind of a dry year transaction-wise, there were quite a few investments and transactions made in transition. So that market continued to grow, obviously kind of supported by the IRA. But what you also see is that the yellow bit, the non-renewable energy transition is growing as well. So it now accounts for about a quarter of the investments made in 22. On the next slide, Roland, if we kind of bridge the gap here, so we've all seen these slides or these kind of charts a number of times. This is from the IEA that does a really highly recommendable world energy outlook on a yearly, on an annual basis. But it's also like a 500 pages document, so quite significant. But what the chart here is illustrating is how much emissions that we've seen in a global context over the years, and how it needs to progress. So if we look last year, we don't have the accurate numbers yet, but it seems like it's going to be around 41 gigatons, so another record, so to speak. And what needs to happen is that before 2025, so that means this year, these emissions need to have peaked for us to have any kind of idea to meet the 1.5 degree Paris Agreement target. And in order for that to happen, so some of the things that we've seen, and so for instance, the COP 2028 statement also said that we need a 43% reduction in global CO2 emissions compared to the 2019 levels. We need a 43% reduction by 2030. So if you look at that, that's actually halving. So only 50% of what, or bringing it down 50% from where we were last year. So quite dramatic changes needs to happen. And what that leads to is obviously these investments in energy savings and renewable electricity generation, etc. What we saw in 2023 was that investments into renewables was around 1.8 trillion, and that needs to grow to around $4.5 trillion on an annual basis by 2030. So magnificent investments are needed in this space. If you look at the two bottom charts here, obviously wind and solar is a big part of it and needs to quadruple from the 2020 levels to 2030. And what we also see is electric car sales needs to grow significantly. In 2020, 1 in 25 cars that was sold was electric, and now it's 1 in 5. So there's definitely a good progression there, but it's also a necessary progression to have any kind of ambition to reach the net zero target in 2050. On the next slide, Roland, if you flip to that, I'll just briefly say this is another way to kind of look at the investments needed. So if you look here around 23, fossil fuels actually accounted for almost 80% of the energy supply, and that obviously needs to be significantly reduced, meaning that we need to grow solar, wind, bioenergy, and also other areas. Today, if we look at kind of the traditional renewables, which is solar, wind, and hydropower, actually hydropower accounts for about 50% of the renewables, but what needs to grow is the solar and wind. Stig will come back to this kind of illustration a bit later on in his mix. So I'll probably leave it at that. But clearly we need to grow. And I know there's some discussions on nuclear in general. Obviously in Germany, the last nuclear power plants were shut down last year, and you can kind of compare that to France, for instance, where 70% of the electricity comes from nuclear. So there are different strategies and different views on nuclear. But if let's move on to some of the regulatory support that we've seen in the past couple of years. In particular, we've seen in EU, we've seen the Fit for 55, meaning a 55% reduction versus the 1990 levels. So they're all kind of different years that they kind of put the marker in, but significant reductions here, and the ambitions have been growing, where previously the reduction target was only 40%, and that has now been increased to 55%. And many of the member countries, including Germany, obviously is part of this, and is already quite advanced. So taking Germany, actually, if you look last year, more than 50% of the energy actually came from renewables. So that was a really great improvement, but also specific targets for build out of solar and of offshore wind in particular. I mentioned France on the nuclear part, but also in the UK. Actually, nuclear, especially small modular nuclear, is a couple of areas that they're looking into. And generally, I'd say there is you say there is a lot of support, but some are still seeing that in EU or in Europe in general, it's more kind of a stick, whereas in the US it's a carrot. So meaning that in Europe you're penalized if you don't meet these kind of targets, whereas in the US you're given kind of support to meet the target. So it's a slightly different way to look at it. But many are calling the Inflation Reduction Act a game changer in the US, and it certainly has accelerated investments in clean energy and in carbon capture as an example. I'll come back to a case on that. But a number of different kind of opportunities where also the Jobs Act, so having internal or domestic creating jobs domestically is a big part of this. So what in general we see is a lot of government support in different ways, but a lot of support that kind of adds to this this tailwind that we see. If you flick to the next slide, Roland, what we've been working on here at NEO is the kind of trying to map all the different opportunities out there. And when we went through that exercise, we found that there were almost as many definitions of transition as there were GPs. So all would have kind of different angles to it. And we've tried to illustrate in illustration there to the right what the types of subsectors are within this theme. So you have wind and solar and hydro, so the established renewable investments. And then as you kind of go down the list, you see some areas that are growing, carbon capture being one of them, recycling being another one, but also where it's slightly difficult to determine, is this really infrastructure or is it private equity? And maybe it doesn't matter what it is, but for quite a few people it matters in terms of when you do the investment, what kind of buckets should you put it in. So so at least be aware of that. What we've also seen is there's been a lot of new entrants coming into this market, and that means that many either you come in just completely new, you come in and say you've kind of rebranded yourself. Previously it was energy, but now it's transition. So need to definitely be careful on the level of experience in this area. Then we've seen a few areas where they kind of link all together to the key discussion on, are these investments, or is this fund an Article 8 or an Article 9? To be honest, I'm not sure that's the right question to answer, because if you, let's say you invest in an Article 8 investment and you transition that so it could actually be sold as an Article 9 investment in due course, then you've really made a strong impact and a strong transition, and that it's often kind of overlooked that there is a lot of investments and transition and impact that you could do by investing in something that's not completely green today, but actually making this particular transition. I can see that time is ticking, so we'll probably need to all the speed up a little bit. So what we found during kind of our mapping of the universe, and we stopped counting when we reached the 100. So a lot of investment opportunities out there. We see there's about 100 billion is currently being raised in transition. We just recently saw Brookfield having their first close in their second transition fund of 10 billion, so quite a significant closing as well. And transition in general has been, especially when we talk about renewables, has been part of many diversified infrastructure funds for quite some time. But what we see is that few GPs actually have a track record that you can do a lot of analysis on. So that's the many new entrants in the market, and those that are maybe on their fourth or fifth fund series are typically ones that have rebranded themselves, so they haven't always been in transition, unless you count CIPs coming on here a year later on, who's been doing renewables throughout the period. But what if you kind of look at it, what are some of the key risks that we've seen? Technology risk. So we've only focused on those where there is a proven concept. Otherwise we would characterize it as venture, or if you're only at the pilot stage there. It needs to be a team that has experience in this area, even though they may not have experience with this particular technology, then related types of investments. Part of these investments may be quite a bit of a greenfield component to them, especially if it's like the build out of renewables. So you need to think about that in terms of deployment, what you're planning for in terms of the investment deployment here as well. And then, at least for us, it's been important that we are disciplined in terms of these investments should have infrastructure characteristics. So it should be hard assets, there should be long contracts. So these are kind of some of the elements that we've been looking at. But quite a few that we see are some that have infrastructure characteristics, but probably not mature. But what they then end up doing, or at least plan to do, is to eventually, once they've built the platform, grown the asset, that they can then exit and sell to kind of a more established infrastructure GP. I've brought two cases here. I'll go through them fairly quickly, just mindful of time. But if you flick to the next one, Roland. This is a carbon capture investment in the US, in North Dakota. And what's interesting both on this, but also on carbon capture in particular, so carbon capture has been as a technology has been in existence since 1972. So it's proved and tested technology. And this particular carbon capture is at an ethanol facility. And one of the things that's quite important there is that ethanol emits almost pure CO2. So it's because you need the CO2 needs to be pure for it to be injected underground. And this being based in North Dakota, there's good geology for this. So we've seen here in 23 there were 6 new carbon capture facilities that were approved, and 4 of those were in North Dakota. So it's a good area to be in. So the plan for this this platform is to capture and sequester more than 550,000 metric tons of carbon or CO2. That equates to around 55,000 households, and that's more than there are in Germany. So it's an important factor to be able to capture the carbon here. We've also seen some investments in carbon capture simply fold and not succeeding because in cases where you need to transport the carbon for either through pipelines or on trucks, because of the factor or the terminology NIMBY, so not in my backyard. So you definitely want to not having to transport it for long periods or long distances. And in this particular time, in this particular case, it's actually right next to the facility. So this is just an example of an interesting investment, but where there are details that are quite important to note, and other also that you would think were well recognized and experienced managers have actually led to being some issues there, so they couldn't complete the investment. The other example I have here is in tire recycling, and even though I know these two types of investments are kind of slightly unique, so renewables will also be a big part of this transition, but I'm just leaving that to Stig to talk more about. But this particular case is about circularity. So, for instance, in Europe, we have 3 million tons of tires every year, and instead of kind of putting them on a ship and sailing those to India and then burn them in India, which was done not that many years ago, if you can actually recycle these tires, you can use part of it again for tire recycling. You can use some of the oil for as components in plastic, and you could also it's also important to note that carbon black, which is part of these of the rubber and the tires, today around 50% of that comes from Ukraine and Russia. So that's an additional feature to think about here. So as an example here, this has been a partnership that has started out with Michelin and the Swedish tire recycler who's kind of built that the pyrolysis that is needed to recycle these tires. So they already have a plant, so it's tested. It's been running for 10 years, and then with the support of Antin, the French UK infrastructure manager. So these were two examples of investments in transition. So one in energy transition and one kind of in the climate transition space. So just to summarize, there are clearly a number of macro tailwinds, both from governments, from the net zero targets, and from the consumers actually wanting net zero investments. Then when investing, worthwhile to think about what you want in terms of deployment profile, also on whether they have the pure infrastructure characteristics, and simply just balancing the return and risk here. And then the last point is that try to find some GPs that are at least somewhat experienced in this field, because there are a lot of uncertainties in value chains and in the operations as well, that can where you can be caught. So, but at the same time, a lot of interesting investment opportunities and opportunities to do well by doing good as well. I'll leave it at there and hand it over to Stig.
Yes, thank you very much, Ulla. I already have a few questions for you, but I will keep them back for the Q&A because I guess Stig will also join. And so first of all, Stig, thank you very much again for taking part in this webinar, and I will hand over to you.
Yeah, thank you very much, Philip. Also, thank you for inviting for this. So what I would like to do today is to talk about also climate transition as Ulla was doing, but from a purely renewable energy perspective, and in particular Greenfield. So how can we do real additionality in the world, and then put it in the lens of what are the challenges and opportunities seen from an investor perspective. So next, so on the next page, just to say that I'll do that. Roland, will you shift page?
Okay, shall I do it for you?
Yeah, yes, please. Thank you. So first, what is the global macroeconomic situation linked directly to renewable energy? Then about how to invest in the area, and then I have a case German study which is based on a German offshore wind investment. So on the next page you will see that what we really seen the shift, and what we really seen the shift is that, you know, and the inflection point was around 2020. So as you can see on the graph, the upper green one, and this is based on data from IEA. That you really see the shift from, let's say, a carbon economy to a low carbon economy is really happening around that time. So even though we've seen some build out, the real shift we're seeing there, and I think if you look at the total, so all the different energy sources put on top of each other, and I'll get back to that, you will also see that basically they're not growing. But I will get back to that. So, but that the renewable energy part of that is really growing, even with a slightly growing share also of nuclear, and then the more fossil-based energy sources are shifting away. But we are at an inflection point, overall speaking, from a macro perspective, looking at renewable energy. So looking at the next page, this build out is actually underpinned by fundamental economics. So why are we looking at renewable energy? Well, clearly the net to zero race that Ulla was also talking about, you know, how do we get towards that, and what do we need to do to let's say alleviate global warming and to basically take CO2 out of the equation. That is one thing. It has been added the fact that we have a very high geopolitical crisis. Just taking two countries in Europe, Italy and Ireland, both countries that are or were heavily dependent on gas from Russia, and didn't have nuclear, and were in need of raising the bar for energy independence. Basically, both countries that have embarked on a fairly aggressive wish for build out of offshore wind, just to take two countries as an example. And then on the other part is also that how can that actually also become an industrial enabler, and not least in a European situation where how can industries in Europe, so that those that is in Germany, for example, making cables, or in Spain or Denmark making wind turbines, or the ship owners that is building out vessels to make the installation. So there's a whole industrial push as well. And on the left-hand side, that actually leads to very attractive economics. So if one were not to do the, let's say, climate transition for the climate or for the geopolitical reasons, then there's also financial reasons. For a number of years, onshore wind and solar has been a better and cheaper way of building out energy than coal or gas. And offshore wind has gotten there over the last few years. So even from a financial standpoint, then the levelized cost of energy. So what does it cost to have 1 megawatt of energy produced, built? Then that cost is now competitive with that of fossil-based sources. So quite an interesting development that underpins, let's say, the build out of renewable. On the next page, I will stay brief on that, but basically the clean investment need to get there. I think Ulla talked briefly about that. So just saying that's in high growth. By the way, clearly there's a big, let's say, private investment alternative to otherwise a very public investment in the past in the energy space, and of course I would not need to talk to you about that, but of course something that I'm seeing from my chair, but clearly also that you are a big part of that in investment thesis, and it's supported by policies, the IRA as the most well known, but the Canadian program, the Greenfield across the EU, or also not on this list, but also let's say the German deal to inject 20 billion into that transition as well. And we are also seeing that in Asia. And by the way, also they have a very high focus on the geopolitical situation and the energy independence, which takes up a lot of space in making sure that the green transition happens. So a lot of things has happened over the last few years, and a lot of action is being put behind that. Looking at the next page, we've also seen that inflation and has meant that capex, so the capital expenditure you need to do, for example, build out of offshore, has gone up. That the same goes for battery storage or certain on onshore wind, but it has been, let's say, balanced out by increases also in offtake prices. So the increase we've seen in energy prices actually supports the build out of renewable energy. So both, again, climate, energy independence, the economics of building out more so that the cost goes down, but also the fact that there is, let's say, a buyer universe, both from public utilities, but also more and more private buyers of power, of so-called PPAs, is an increasing price, and it's an increasing, let's say, volume of buyers of renewable energy. We've seen the different commodity and freight prices come down to a level closer to the pre-COVID situation, and of course interest rates increased dramatically. They have now come somewhat down. They're still at a higher level than we saw, a few years back, but at least leveling out and being again put into a price level on capital expenditure that is offset by higher power prices. So I think that's the backdrop on the macroeconomic situation. So what does that mean, going 2 pages forward, for how then to invest and for an investor into renewable energy? And here really talking about the greenfield part of it. So where the early development takes place, where that means that there's also from an ESG perspective real additionality effect, so that it actually is something that comes in addition to the energy mix that we have. So either it takes a growing need for energy in some countries, or which I will get back to, and which the IEA is also predicting, that we will grow the part that power is of the total energy mix. So more energy will come from producing power, so electrical power, and less from let's say fossil fuel based liquid forms of power. And that actually is underpinned by this. So here the example is that it takes a much more industrial approach to do greenfield, because you do development, you do and the develop means getting permits, getting access to grid, actually doing the pre-planning of building, then making the agreements on selling the power, making agreements with the EPC providers and those producing main equipment, turbines, solar panels, if it's transmission, then cables, and so on and so forth, and then actually do the construction and then operating. So a very industrial approach to this. I am myself representing an organization where we do have a very industrial focus to this. There are also, of course, you see a lot of development companies doing that, but also more and more of utilities which are shifting their focus away from not only being on the fossil side, but also being on this side and actually being part of building out the renewable energy from a greenfield starting base. So from an investor perspective, that means you're part of an investment that actually needs quite a lot of capex for a number of years. If you want to build an offshore wind farm from start of early stage of a project to actually putting it into operation, typically it's 8 to 10 years. And within that time frame, you then actually you agree a PPA, so a power purchase agreement, and you build out your capex, and then you have an operating assets for a lot of years. I think Germany has built out some, and there's big build out plans. And most recently last year announced at a North Sea summit with Ursula von der Leyen, that was heading that with the countries around the North Sea, with a very let's say bold targets on offshore wind build out, including also looking at potentially having an artificial island in the North Sea, and several countries are looking into that. The Netherlands is looking at that, Germany is looking into that, and Denmark is looking into that as well. And you are actually able, because you can log in, again, looking at it from an investor's perspective, you can log in many of the components and thereby deliver attractive risk-adjusted returns with a positive ESG and CO2 impact for investors, but also for stakeholders at large. And here's some examples of some of the latest funds that CRP has raised. But it's just to illustrate that it's both, let's say, a climate effective way. It's good for let's say enabling energy independence in these geopolitical days, and it does deliver a good return, and it has a positive additionality impact on climate. So those are, let's say, a multitude of factors linked to what is happening in renewable energy. So if you look at the next page, is that there is, let's say, a growing institutional capital allocation to infra, and again, I'm surely not talking to someone who doesn't see that, so I'm sure you see that as well. But it's happening at a large scale globally, and it's rather massive. And it also supports what the IEA is saying on the build out, that there is private capital allocated to infra. It also means that, as there is both, let's say, lack of efficient capital allocation to the greenfield market, then that also means that there is actually a premium to be had from a financial perspective to be the one that does the build out. Because the brownfield market is still a lot bigger portion, given also that many investors are, pension funds, life insurers, and so on, where what they're looking for, of course, is a de-risked product, financial product, and the Greenfield development part of this can then translate by de-risking it through this, let's say, industrial approach that we just looked at on the prior page, into a de-risked financial product that becomes a brownfield asset that then attracts a premium for the Greenfield constructor and towards the brownfield potential owner of that asset, which then, by the way, is often a critical asset in the country where it operates. Looking at the next page, I think it's rather saying that, as the IEA says, in 2020 we had an energy consumption of 390 and in total energy, of which power was 20%. Of those 20%, 30% was renewable. There's a slice of nuclear that goes into that power market as well. The IEA predicts that the total global energy consumption would slightly decrease towards 2050 in the next 30 years, maybe slightly counterintuitive, but coming from the fact that there will be a number of energy optimizations, energy efficiencies, better use of energy, both in the usage side on the production side. So that's the reason for why the total pie is slightly decreasing. But what the overall prediction is also that power will go from 20 to 50% in 30 years. And that's a massive movement. And from being, 6% of the total energy market from renewable, it's more like some 20 to so more like some 30% of the total energy market that comes from that. So a massive shift towards renewable energy as part of the electrification. So that shift we're seeing massively. Next to that, part of the fossil fuels will also be substituted by, here we call it power to X. And the reason why we call it X is that could be hydrogen, it could be green ammonia. So there are different sources of liquid energy that will also be part of the mix. And it would be a better use of advanced bioenergy, which could be, for example, in hard to abate sectors, where you create liquid fuels or gases, for example, out of manure or other sources. And then in 2050, they still predict that a small part, in around 10%, might still come from fossil fuels, but quite a transition that is expected in this time horizon. If you look at the next page, I think here just talking about this is only possible if the players in this market they operate with actually securing, because of the time lag, I said 8 to 10 years on offshore wind, a year and a half to 3 years on offshore wind and solar, storage and transmission, anywhere from, I would say, 2 to 5 years to do big transmission projects, battery projects, pump storage projects. So you need to work on a pipeline, and basically for that to become investable projects, you need to work on that right now. This is an example of the 120 gigawatts that is in the pipeline of CIP. But if you would take big utilities, they would also have pipelines that they are building out to actually build new renewable energy, so that to support the overall energy transition. And the next page, it's just to give an example of that in the context of CIP, that it's happening globally. So the geopolitical situation is not only something we see in Europe, as we have, war on our doorstep in Ukraine. We also see it in Asia, where let's say the wish to be more and more energy independent means that countries like Japan and South Korea and Australia is looking at building out, for example, offshore wind, but also onshore wind, and those countries also looking at how you can, let's say, increase the capacity of the power market and thereby into the energy system, inject both, let's say, batteries and also a higher amount of investments into transmission, so that the overall power grid does not get congested and thereby risk that there will be curtailment on power being produced. And as we have a short Q&A at the end, I'm happy to take questions. I hope I'm not getting too detailed on something that I'm hugely passionate about, but just wanted to give you an idea about that. On the next page, just also when you then translate in how does that look like from an investor perspective, is that as you do long-term power purchase agreements, that provides you with a downside protection as an investor. You would not do that on 100% of the expected revenue stream coming from producing power, because you still would have a slight merchant revenue stream. In essence, that actually means that you get some, let's say, natural hedge towards inflation/power price increases, and also you do that, let's say, as an upside potential in the tail, making sure that you have a sufficient secured cash flow to back up your investment in the initial years. So really also looking at it from a financial and de-risked lens. So even though it's Greenfield, it's still hugely viewed as something where you need to do a de-risking through power purchase agreements, and also enabling, let's say, a natural hedge to inflation. And if you look at it on the next page, from what has happened over the last years, and just looked at it in 22 in the lower right corner, just to say that infra assets on not being listed had even in a year where equities were minus 12%, high yield minus 16, real estate, at the very low end, but infra being, let's say, slightly positive. But it's simply just showing that it actually is quite, let's say, resistant and not correlating a lot to what goes on in the overall underlying market on equities. Just quickly to put it a little bit in perspective, I love pictures is sometimes better than anything else. 2 pages ahead. Then here you can see the project called Veja. It's in the German part of the North Sea. It was let's say finished in 2015, and here you can see during the phase of installation, installing turbines, the maintenance platform which is right next to it, and this is an operational project as it is right now, producing power for more than 500,000 German households. So very good for ESG and climate, but also very good for energy independence. So this is part of the let's say energy mix in Germany. And on the next page, just a little bit more about that this is also an example of how such a project comes about. The company that I represent, together with Siemens and others, actually invested in the project, built the project. We then actually sold off a part of the equity stake, so that to take part of the Greenfield premium at that stage. We know the project very well. We like the project, so we kept a mezzanine stake. So we still are still part of the debt structure of the project. But it's just to give you a full flavor of how you can be a Greenfield builder and developer and builder, should say, and then take some of that Greenfield premium to de-risk, let's say, the financial exposure, and still have a positive cash flow stream from being attached to a project going on. And I think these are some of the, let's say, things that we see maturing more and more, that there are ways of being part of that, let's say, income stream, and thereby de-risking, let's say, the returns for investors in the alternative investment space when you go into greenfield energy projects. On the next page, just saying something that I think in any construction project that you would be proud of, you know, it was built, let's say, ahead of time, within budget, and it actually was able to during the construction time, which you are often seeing when you build the wind power projects offshore or onshore, that the turbine manufacturers can potentially, let's say, improve the power output, and this was also the case here. So there was actually being enabling boosting the outcome on each of the turbines. So that was quite good, and was a support to that project. So with that, I just wanted to thank you for listening in, and hope you are as excited about this asset class. And so any questions to, you know, the asset class or how we operate and so on, very welcome to now or at some later points. I guess over to you, Philip.
Yes, thank you very much, Stig, and thank you, Ulla, for joining us again. Let's dive directly into the Q&A session. In the very beginning of the webinar, I shortly mentioned the mega election year, and what I'm talking about is, first of all, Putin will be confirmed in March for the next 6 years. In June, we have the European Parliament election, and of course, probably the biggest challenge in 2024, the United States was itself. We have the election in November, and in the very morning I checked the bookies' odds, and I was kind of shocked how big of a favorite Trump is already. I mean, I knew that Trump is a favorite, but not that big of a favorite. And I guess that there are many investors out there who are not aware of this yet. And maybe we can start with this topic. Ulla, you already mentioned the Inflation Reduction Act in the beginning of your presentation, and we have questions from the audience about who is going to finance, in general, the energy transition and the investments needed. I remember one slide, I guess it was slide number 5 of your slides, Ulla, and also Stig, you mentioned the financing gap that is still there and out there, and it probably will be more difficult with the government under Trump. So what is your outlook on these topics?
I'll go first, and Stig, please chip in as well. It's certainly an area that we've had a lot of discussions with different GPs about, because even though we are all excited about the IRA, obviously if it ends up going away, if the Republicans and Trump come to power, then it's a very different story. So I guess two factors are important to note, and meaning that we are still fairly, I don't know if relaxed is the right word, but we're not relaxed about Trump potentially becoming a president. But in terms of the risk of the IRA going away, if Trump ends up being the president, we don't think that is that will be the outcome, and two reasons for that. One is that actually the IRA is very much benefiting the Republican states, so kind of that middle section of the US, for instance, North Dakota, where I talked about the carbon capture case there. So while the Democrats in general has supported the IRA because of the environment, etc., the Republicans tend to have supported it more because it's creating jobs in those and benefiting the Republican states. And secondly, what we see is that even though we talk a lot about politics in the US, it is a lot of it is state legislation. So it is the North Dakota state who's actually approving these projects and giving them the go-ahead. It's not Washington doing that. So will there be some tweaks and some adjustments? Potentially so, but not something that's going to dramatically change these the support scheme as we see it today. At least that's our belief.
Yeah, maybe just to add a few words from my side. I think the let's say what's potentially happening in Russia, I think that just underpins the geopolitical situation and the wish and need for energy independence. So I think if anything, that would support the build out of Greenfield renewable energy. And if we talk about the US, I think what has really changed also recently is that it has come to show that there is actually job let's say development and jobs are being created through this industry. So when GE manufactures turbines for the US East Coast offshore wind, that's actually a positive. So I think that has been also one of the potential challenges that has been said, but now it's also shown. So I think on top of what Ulla said, I think that there's a lot of that is actually being demonstrated. Lately, the Vineyard Wind project, which is the first commercial offshore wind project out of Massachusetts, has exceeded its job creation targets and so on. So I think in an election time frame or world, then this is, I think, a key parameter so that it's good for climate, it's good for business, and it's good for jobs.
Thank you very much, Stig, for adding on this interesting topic. Well, let's take another look at the total development pipeline of CIP, and I think it's quite interesting that you rely heavily on offshore wind, and maybe you can elaborate on this. Is there still a premium for investing in offshore, or what is the background of this huge part of the investment pipeline?
I think if you look at the overall wind sector, then onshore wind globally is much larger than offshore wind. It's also true that onshore wind is much more, it's easier to build. It's more commoditized, if you will. So if you look at offshore wind, you need to be a specialist, and I think that's the something that has really been the case for CIP to be a specialist in offshore wind, and we've done that for many years. And to your question, is there still let's say a premium to be had? And I think the answer is yes. And the reason is that it has really found its equilibrium between power prices and capex, so capital expenditure to actually build offshore wind projects, and that has recently been seen on I'm just saying it on a more generic note, that auctions on power prices outside of New York was, a few months ago, was like 35% higher than what we saw 4 years ago. So it's still let's say an efficient energy resource. So there's buyers for that energy, but there's an equilibrium between power prices and capital expenditure, and it leads to that there's still let's say a very interesting and good premium to be had from offshore wind. So but it has been turbulent times. That equilibrium, there's been 12-18 months where you needed to be super disciplined on which projects to participate in or not, but there's still premiums to be had, and we're quite pleased and continue to be pleased with this industry.
Thank you, Stig. Ulla, you want to add on this, or shall we continue with another question?
I guess it may be worthwhile adding as well that that offshore wind in general, you can have bigger turbines. There's actually better wind speed offshore as well. And if you were to build the same kind of capacity onshore, you would need so much land that which you don't have today. So so there's that added aspect of it as well. But obviously there has been increased cost effects that we've seen, and we've seen some investments not proceeding in the second half of 23, but slowly coming back again. And that's where, as Stig mentioned, it's important to remain disciplined in this case.
Yes, I guess we can't rely only on onshore and offshore wind or other renewable sources from tomorrow on. So we need solutions in transition. And there's one interesting case I want to talk about, the case for natural gas as part of the solution in transition. Let's say it this way, the German government at least is positive about it and reached an agreement yesterday, a compromise at least, over the construction of new power plants, which should be first of all planned as gas power plants, and then later on the plants are to be converted into hydrogen power plants. So what is your opinion about this?
So I really think, in terms of gas, I think, there are several ways, so one is, of course, that there's a need for potentially in the short time to use liquefied natural gas for some countries to actually have a base load of energy. But over time, as you also allude to, Philip, then there's clearly hydrogen, which is going to be the really big next thing. It's not just an evolution. It's actually something that is really changing. Whether it's a revolution, I don't know, but it's really a big change and a big step change. So utilizing green power to produce hydrogen through electrolysis, and I think Germany will be one country that will both benefit from this in many ways. There are also big German companies that are active in the space of doing that. So I think what the German government is saying is also being, let's say, underpinned by what is happening on, let's say, the industrial front. So LNG probably as a base load in the short time, but hydrogen really as being the bigger game changer. And also in terms of, let's say, smaller, let's say, base load things is on the biogas side, where basically taking waste, so organic waste, and transforming that into biogas that can be directly put into existing, let's say, networks of gas pipelines is also a very effective way of both doing the green transition, but also securing energy, basically. So there are several fronts where I see this will happen.
Yes, thank you very much, Stig. I guess, Ulla, it would be great if you can close this webinar with your final remarks on this topic.
Sure, and it's an interesting topic, because it's one that kind of is dividing a little bit on whether you can call natural gas transition or not. And as there are different ways of looking at natural gas, as Stig mentioned. Also, renewable natural gas is part of this, but nevertheless, natural gas is very flexible. So it's good to use when the wind isn't blowing and the sun isn't shining. So it can kind of add that you will continue to have energy in all circumstances. And also natural gas, obviously, compared to the likes of coal, has significantly lower CO2 emissions, about half that of coal. Doesn't mean that we should continue just moving in that direction. But if you could go if you could close down coal and go to natural gas, there's quite a bit of a benefit in that area as well. And that kind of comes back to what I mentioned previously on Article 8 and Article 9, because if you are an Article 9 fund, you can't have natural gas. So it is, but you can actually still make a very significant transition as well. I think it's definitely a necessity to have in, as part of the solution, at least on the short to medium term.
Thank you very much. And again, good wrap up for today's webinar. Dear listeners, thank you for tuning in today. I hope we will be able to welcome you back in the upcoming webinars. Again, thank you very much, Stig. Thank you very much, Ulla, for your interesting insights today. I hope you have a great day and a great week to come. Thank you very much.
Thank you.
Thank you, you too.